Most ETF videos give you a list built for someone with 30 years to wait. I don't have 30 years. I'm 49. And every financial decision I make from this point forward has to work harder, faster, and smarter than it would for someone who started at 25. So I built a different list. 7 ETFs, chosen specifically for someone with 5 to 15 years, not 30. Let's get into it. Here is the problem with most best ETF lists. They assume you have decades of compounding ahead of you. They load you up with small-cap growth funds and aggressive international exposure, assets that need time to recover from volatility. When you are 49, a 40% market crash followed by a 5-year recovery is not an inconvenience. It is a retirement-ending event. Late starters need growth, but not reckless growth. Income starting now, not later. Stability, so one bad market year does not wipe out a decade of catching up. ETF number 1, VTI. This is your foundation. VTI gives you exposure to over 3,700 U.S. companies in one fund. Expense ratio of 0.03%, almost free. For a late starter, VTI is non-negotiable. It captures the entire U.S. economy. When the market recovers, you recover with it, fully. Target allocation, 30% of your portfolio. This is the ETF I wish I had started buying a decade ago. SCHD focuses on high-quality U.S. companies with consistent dividend growth. Current yield around 3.5%. These companies have raised their dividends for 10 or more consecutive years. SCHD pays you while you wait. You do not have to sell shares to generate income. The dividend compounds, and in retirement, you live off it. Target allocation, 20%. ETF number 3, VXUS. Do not put everything in the U.S. VXUS gives you exposure to over 7,000 companies across developed and emerging markets. When U.S. markets struggle, international markets often do not. This is basic diversification, and it has saved portfolios in every major U.S. downturn of the last 30 years. ETF number 4, VNQ. Real estate without owning property. VNQ is a REIT ETF. It holds over 160 real estate companies, including apartment complexes, data centers, and commercial properties. Current yield around 4%. Real estate returns have historically outpaced inflation, and VNQ delivers that, without a mortgage or a tenant. ETF number 5, BND. As we get closer to retirement, we need a shock absorber. BND holds thousands of U.S. bonds, government and corporate. It does not grow fast, that is the point. When stocks fall 30%, BND typically falls 5 to 8%. It is the part of your portfolio that lets you sleep. At 49, I hold 15% in BND. By 55, I plan to increase this to 25%. Target allocation, 15%. ETF number 6, JEPI. This one is specifically for late starters who need income now. JEPI uses a covered call strategy to generate monthly income. Current yield around 7 to 9% annually, paid monthly. For someone 5 to 10 years from retirement who wants to start building income before they stop working, JEPI is a powerful tool. Target allocation, 5%. ETF number 7, QQQM, a small allocation to high growth. QQQM tracks the NASDAQ 100, the 100 largest non-financial companies on the NASDAQ, dominated by technology. Apple, Microsoft, Nvidia, Amazon. Yes, it is volatile. But at a 5% allocation, the volatility is manageable, and the growth potential over 6 to 10 years is significant. Target allocation, 5%. Here is the complete picture. VTI, 30%. SCHD, 20%. VXUS, 15%. BND, 15%. VNQ, 10%. JEPI, 5%. QQQM, 5%. 7 funds, 1 portfolio, built for someone who needs results in years, not decades. None of this is complicated. You do not need a financial advisor, a Bloomberg terminal, or an MBA to build this portfolio. You need a brokerage account, a consistent monthly contribution, and the discipline to not panic when markets drop. If you are 45, 50, or 55, the window is smaller than it was. But it is still open. Start with one ETF if that is where you are. Add another when you can. Let compounding do the work. Next week, I'm going to show you exactly how much you need to invest each month in this portfolio to retire by 55, with real numbers based on 3 different starting balances. Subscribe. It is free. And I will see you in the next one.